Hello. Hey, how are you doing? I hope that you are doing well. It's been a while since you heard from me, but there's been a lot going on in the market here over the past few weeks, and you may have noticed if you've been following the market, and if not, good for you, because you're probably paying attention to what's going on with the pandemic, this coronavirus, COVID, whatever the case may be. So, in case you don't know who I am, my name is Nathan Garcia. I am a certified financial planner and retirement planning specialist, and I do these videos to help educate people and to give them feedback and insight from a certified financial planner. In this video, what I want to do is share with you how to invest in a down market. And the reason that that's so significant is because right now I've been getting a lot of texts and emails and phone calls about when to get out of the market. Some people who I've been speaking with for a long time are wondering when to get back into the market. And there's a lot of confusion about what to do. And this is amplified, the confusion is amplified when folks don't have a plan. And so today, what I am going to share with you, what you're going to learn is how to set up a plan so that you can invest confidently in the market and you can look at periods of volatility like what we're seeing today or what we've seen over the past few weeks. You can look at those periods as opportunities for you to increase your wealth and instead replace your emotions of fear with confidence. So what we'll do is let's just walk through a couple slides here, and I'll share with you exactly what I mean. I am going to share with you some planning techniques. I'm going to share with you some securities. I'm not telling you to invest in these. I'm not telling you this is a financial plan for you. Just because I'm licensed as a financial advisor doesn't mean that the information that you see here is going to be specifically for you. Don't take this as financial advice for you. In fact, it's just for educational purposes only. If at any point you have some questions about your personal situation, you want some help, go ahead and text the number below there, 202-558-8439. You'll be able to get in touch with me, and we have a fully online virtual process, and I can answer some questions for you. So with that out of the way, let's go and talk about how to invest during a down market. If you have been looking at the market over the past few weeks, then you know that the market's actually down pretty significantly. When we look at the current performance, looking at today's markets, this is a resource I use called Koyfin, KOYFIN.com. That will give you a pretty good resource for you to be able to track market performance. Here, what we're looking at is just the performance of the major indices. When you look at the normalized performance here, you see the Dow, the S&P, and the NASDAQ. Today is one of the few days that it's actually positive. You know, the past few weeks, it's been really tough. If you look over the past month, you see that the market's down about 23% for the NASDAQ, about 28% for the S&P, and then the Dow's down about 31%. So needless to say, there's been a lot of volatility. There's been a lot of concern among investors about what to do with their portfolio. And that has prompted me to have the same conversation with a lot of people. And I want to just share, some of the highlights from that conversation in this video here today. So the first thing that you want to look at is making sure that you don't let your emotions override your investment decisions. And the easiest way to do this is to build a holistic investment portfolio, to build a investment portfolio that is integrated with your overall financial plan. And so let me show you kind of what that looks like here. So the big thing, sorry about that, jumping around, sorry. Here you go. So the big thing is that you want to set up your investment portfolio in a manner that is in sync with your needs, with your life, with your lifetime, with your needs for managing your money. And the easiest way to do this is to think about three different buckets. You're going to have a short-term bucket that's going to hold anywhere from 6 months worth of your expenses in cash, all the way up to maybe 2 to 3 years, kind of depending on where you are in life and your attitude about risk. And then you also want to have a second bucket that's going to be more midterm. That's going to hold your money that you won't need for, let's say, 3 to 5 years. And then you'll have a third bucket that's longer term, and that would be where you keep your money that is going to be used in 5 years plus. And when you start to segment your money in this way and you say, I'm going to have three different buckets based on three different time periods, what can happen is you can manage the investment risk a lot more closely than you would if you just had all of your money piled in a one big portfolio. So what you can do is you can start to segment your risk and say, how is my money split up over the short, mid, and long term, and what amount of risk should I take in each of those buckets? And so the first area that you want to begin with is that short-term bucket. And again, you want to have typically about depending on where you are in life, at least 6 months of expenses in cash. Maybe it could be as much as 3 years if you're living on a pension, fixed income, what have you. And ideally, this is invested in securities that are very liquid, meaning that you can turn them into cash pretty quickly. These might be held in accounts like your checking, your savings, your brokerage account. It might be held in some cash that you have at home. And typically, this is going to be invested in like money markets or CDs or investments that are really liquid that you can turn them into cash very quickly. You see a lot of panic selling right now where people are concerned about their ability to get money out of the market. And that's because they don't have a plan. And in addition to not having a plan, they probably don't have the emergency reserves to get them through the short period of volatility. But like you saw today in the market, the market's actually up. As soon as you get out of the market, the biggest question that you have is, when do I invest? When do I get back in? And unfortunately, what I've seen is with a lot of people, they let their fear drive that decision-making process of when they get back in the market. And that causes them to stay out, to stay in cash too long, and thereby miss out on a lot of the upside when it does come. So by having that short-term bucket, you should have enough peace of mind that, hey, the market could drop 20 or 30%, doesn't matter because I already have my 6 to 36 months worth of expenses in cash. So my life really doesn't change over that time period because I've got cash invested. And as a result of that, I can stomach a little bit more volatility, a little bit more uncertainty in my investments. So if you think that that's helpful, go ahead and send me a text there at 202-558-8439. Let me know what you think is the right amount of cash that you should have, kind of based on where you are. Now, I told you that you want to have three buckets in order to manage your investment portfolio. We talked about the short-term bucket. Now let's talk a little bit about your midterm bucket. That midterm bucket is going to hold anywhere from 1 to 5 years worth of expenses. And that's going to be your bucket that is invested a little bit more aggressively, but not super aggressive, where you have to have to really worry about the investment performance and the ability to generate to get back that return. To get back that principal. And so you might find that those assets are held in a brokerage account, or maybe they're held in your IRA account. And you might find that you're investing those assets in equities. Maybe you're putting them into some different funds, like what you see there. The decision is really up to you, but what it will do is it'll allow you to take a little bit more risk so that you're beating inflation, but not take too much risk where you're concerned about the return of your capital there. And then finally, you might look at a longer-term investment portfolio. This would be for investments that you may not need for 5 years plus. And this would be in a brokerage account. Maybe there's less liquid accounts that you have, like a Roth IRA or an individual retirement account. Those are tax advantaged accounts, accounts that you're going to benefit from not having to pay taxes on an annual basis because they're deferred until retirement. Those can be really helpful for accumulating wealth, for you to manage your taxes when you take out the money from there. And you might find that you're putting in funds like the total market fund from Vanguard, Vanguard VTI there. That might be a fund that you put in there where it's going to have maybe some more volatility. You might see that that account is down, 20%, but because you know that that money is not going to be used for 5 years plus, it should give you the stomach to go through that volatility and not be too worried about it and not be too concerned about the day to day or the week to week or even month to month movements in the performance of those accounts. So that is a holistic way of looking at your portfolio, of managing your portfolio, and hopefully you understand now how that can allow you to invest in a down market. In my experience, when you have a portfolio that is built around the timing of when you'll need the money, then you'll be able to withstand the volatility and not really be as concerned and definitely not be as reactionary to what's going on in the market. On a day-to-day basis. So hopefully you found this helpful. If you did, let me know. You can text me at 202-558-8439. If you have any questions, even if it's something that you think is silly, go ahead and reach out. I'd be happy to help you out if I can. And if you like this video, you have questions, leave a thumbs up, leave some comments, and reach out to me. That's my office line there, the 589-0211, and you can book an appointment with me or see some additional training on my website, fiduciaryfirst.com. So thanks for checking this out. Hopefully it was helpful for you, and look forward to seeing you in future videos. Thanks so much, and take care. Bye-bye.